macroeconomics to determine how the news applies to real estate investing. My goal is to help you stay informed, to make better decisions, and of course, make more money. So let's dive right into it here. Some of the headlines that caught my attention over the weekend. First and foremost, taxes. Taxes. I hate even mentioning the word, but it is very important that we are cognizant of what's going on in the landscape as far as the political landscape when it comes to taxes. And fortunately, we are real estate investors, so we take advantage of the most tax-friendly asset class the world has ever known. We can take depreciation, we can move, we can sell, we can move it to another property with a 1031 exchange with no tax ramifications. There's several things that we can do. The only thing that really gets taxed at normal income is the income stream or the cash flow that you have from rental properties. But with your depreciation, if you use enough leverage, it can pretty much wipe it out. So there are certain taxes, capital gains, that apply if you choose to sell a property without doing a 1031 exchange. And these are the taxes that I really want you to pay attention to, because I think that, we get caught up in our daily lives, taking the kids to school, going to your job, just taking the kids to soccer practice, the football game, all these things. And you kind of pay attention to the news, kind of, but not really, because who wants to? It's depressing, and you just see a bunch of talking heads that are spewing just mostly nonsense. So you kind of tune it out. But I'm here to remind you of what's going on so you can prepare for it. So most of the Democrats want to raise the capital gains tax and basically make it the same as income. So if you don't know, right now the long-term capital gains tax in the United States kicks in after 1 year. So if you sell a property after 1 year, any capital gain that you have is taxed at around 20%, which is lower than the highest marginal rate of 37%, roughly. I think it's 39 when Obama was in office. So what they want to do is they want to take that and they just want to pretty much eliminate capital gains tax and just take it all the way up to 40%, make it like the highest income tax bracket. So they say that this is to kind of make sure the rich pays their fair share, yada, yada. What, of course, they failed to mention is that it will affect the majority of the people that will affect aren't rich, or they're just middle class, normal people just like you and I. So right now, if you have a property under a year, so if you're a house flipper, then anything that you do, that you turn over, any gain that you make on that flip is going to be considered short-term capital gain, and that's already taxed at income. But if you're a flipper that does bigger projects and you have projects that take over a year, then that can be considered long-term capital gains at that lower rate. So I just want everyone to be cognizant of this. The United States is 23 trillion in debt. That's on balance sheet. If you look at the off balance sheet, the unfunded liabilities, most economists would put it north of 100 million or 100 trillion, excuse me. There's some economists that even put it over 200 trillion with a T. So that's not a good financial position to be in. And, you've got to raise revenues there. So the chances are extremely high, especially if the Democrats take the office in 2020, that taxes, income taxes, and capital gain taxes will be going up. So a strategy for real estate investors to kind of get around this here is, what I suggest, taking out 30-year fixed rate debt to buy income properties, rental properties in the Midwest or in linear markets where you can buy them under the cost of construction. Then you're not worried about all these taxes. The only thing that would be applicable there would be the property taxes, which I do think will be going up, but not to the degree that capital gains will be going up, because property taxes affect everyone. So with your rental property, you're having your renter pay off the mortgage. You're building equity through the income stream that the renter is giving you. Basically, they're building equity for you. And if you do have any appreciation on the asset itself, then that's just gravy. And what you can do is once you get to the point where you have enough equity in that property, then you can pull out that equity, invest in another rental property, and you can pull out that equity not by selling the asset, but by taking out a loan against the asset, whether that's a refi or a HELOC or however you want to do it. So you can keep extracting equity without having a tax event, is what the IRS calls it. And so that's really what I want you guys to start thinking about, and pay attention to those headlines, but really start thinking about how you can kind of uh, strategize and how you can build a specific strategy to where this won't affect you, but you can still invest in the United States and still have those dollar assets in your portfolio. Okay, moving on here. And this is something that I talk about. Oh, I'm sorry. I didn't go over to, whoops. I didn't go over to the article. I always like to go over to these articles so you guys can see where I'm getting it here. This is in Bloomberg Business Week. So let me just go over this quickly here. Common theme among large groups of Democrats hoping to win the presidential nomination in 2020. It's like I said, they're all wanting to bump that rate up. This talks about how Biden wants to double the rate, so going up to 40% for people with incomes of 1 million or more. But we all know how that works. Once it starts with people who are making a million more, then it gradually goes down to 750, then 500, then 100,000. The next thing you know, it's just a flat 40%. So I wouldn't really, you never trust that when politicians say this is temporary or only for people in this income bracket. So there's the link. Now, moving on to this next article that I wanted to talk about. And this is super important, especially if you're like me. Let me move my head here. Especially if you're someone like me that really likes to invest in overseas markets, to have a diversification within your portfolio as far as the currencies that the assets are denominated in. I like to have a 50-50 split with Colombia and the United States, just because the Colombian peso is extremely cheap right now. And I'm not a big long-term bull with the dollar, long-term meaning, 5-10 years. So, and Colombia is where I spend a lot of time, so a lot of my expenses are denominated in Colombian pesos. So for me, it really makes sense to have a 50-50 split. Now, regardless of whether Colombia makes sense or not, I always encourage people to at least explore investing in other markets. And because the main reason is because the markets are so inefficient. And this article is actually talking about how inefficient the United States market is. But let me tell you what, the United States market is a model of efficiency compared to Colombia or some of the other real estate markets that I have been in. So I actually want to just read this for you really quick here, because I think this is really, really powerful stuff. And I hope it makes you kind of open your eyes and get even more excited about real estate investing than you already are, especially when you compare it to what your other options are, stocks, bonds, etc. So one thing that makes real estate stand out is that there isn't going to be any more of it created, at least not on this planet. We start out knowing that over the long haul, there will never be a greater supply available. Though the supply for sale at any given time varies a lot, the general idea is that the population increases, demand for real estate will increase, but supply will not. Prices should rise over time. I don't know if I agree with that too much there. He's talking more about land. But this is where where I really start to agree. Beyond that, though, it's not really an efficient market, especially in rough economic times. There aren't market makers out there checking out home prices across neighborhoods and markets and buying and selling hundreds of homes at a time to take advantage of differences. There are differences, but they deliver one of the profit components available to real estate investors. Let me read that one more time. There are differences, but they deliver one of the profit components available to real estate investors. The investors can dig into market information and they can do it quite efficiently with the internet and many sources of information available online. Homes for sale at a bargain bargain prices can be located, and even better prices negotiated when there is a motivated seller. Bingo. A bargain home represents inefficiency in the market, and the astute investor can take advantage. I love it. Love it. And that's what I talk about, especially with Colombia so much, is people tell me that, Medellin, the prices are high. And I will absolutely admit that they have appreciated quite substantially over the last 10 years. Now, relative to other South American markets, I think they're still extremely cheap. But where I buy is incredibly cheap because I'm not paying the prices that you see online. The delta between what I pay and what people see online is absolutely huge. I mean, I pay probably 40-50% less than what these people think the prices actually are. Now, that doesn't mean that you can't sell at some good prices if you have the right location and the right product. But again, my point is there's no MLS here. There's no, I can't go into it on this video, but the real estate agents, believe it or not, are incentivized to show the property to as few buyers as possible. I know that sounds crazy to everyone watching this video, but it's true. They don't have exclusive agreements here. They don't have, the real estate agents don't have exclusive um, deals where they're the only person that's representing the property. So again, I won't go into it, but the bottom line is they're incentivized to show the property to as few buyers as possible. The absolute opposite of what's in the best interest of the seller. So generally what happens here, and I'm not making this up. Anyone that's been to Colombia can vouch for me that I'm not embellishing. I would say 90% of the people that sell their properties here, they don't even put them online. All they do is they just put a for sale sign in the window. Sometimes it can be in a 30-story building that you got to get out your binoculars just to see what the stupid phone number is. And a lot of times the wind blows it over, so you can't even see the first three digits of the phone number. And it's craziness. But this is why you can find, if you do the homework, if if you got boots on the ground, if you're patient, you can't just go out there and click on the MLS and look to see what's, within your 2-mile radius, and bam, you just set up an appointment to see all those the next day. Then boom, you make an offer and you buy the place. That is not, it's how it can work here, but not if you want to get super, super, super steep discounts on properties and find those inefficiencies that are 10x in any market outside, not any market outside the United States, but especially South America. The inefficiencies are 10x what they are in the United States. And I completely agree with this article. So again, and this is one of the very few times that I'll agree with an article in the Huffington Post. I can assure you of that. So anyway, guys, just to recap here, we really want to pay attention to what's going on with the political environment regarding taxes in the United States. And we want to start to think of strategies as to how we can circumnavigate anything that comes about in 2020 if the Democrats take office. Also, we want to realize that real estate, out of all the major asset classes, is by far the most inefficient market. And that can either be a bad thing if you don't know what you're doing, or if you're an astute investor, such as this article states, then you can really take advantage of it. And if you're someone that is, willing to get outside the box a little bit, again, no way with 100% of your portfolio, but maybe 20%, 30% of your portfolio going outside of the United States, you can really take advantage of these huge inefficiencies that are present all over the place outside of the United States. Guys, that is the video today. This is Monday. Go ahead and hit the subscribe button if you like this content. Hit the like button. Make sure that notification bell is on. And just as a reminder, Monday, Wednesday, Fridays, the Macro Real Estate Investing Show comes out where I go over these headlines and try to help you stay current and also show you how these headlines apply to real estate investing directly. On Tuesdays, Thursdays, I come out with educational videos. And then on Wednesday, every single week, we come out with a vlog. And that's much more entertainment driven, but it gives you a behind the scenes look as to what it's like to be me basically on a weekly basis, and more specifically what it's like to be a real estate investor in Medellin, Colombia. So again, guys, hit that subscribe button, hit the like button or the thumbs up, and we'll see you guys on the next video.